Okay, everyone, let's go into the new tax law changes for individuals. These webinars are based on the newest editions of the PassKey EA textbooks. This is the cover this year. We're going to have like a little bit of crypto on the cover, this little gold Bitcoin on there. I liked it. I'm the one that picked out the cover image this year. And usually we have something, America related on there, like a flag or something. So there's a little flag and then a Bitcoin. That's the newest edition. And if you're studying for the current testing cycle, it runs from May 1st, 2025 through February 28th, 2026. That's the edition that you want to get. Note, Prometric will not test on any legislation or court decisions passed after December 31st, 2024. Now we have a new administration this year, and sometimes when that happens, we'll get retroactive tax law changes. I understand that sometimes that can be confusing, especially if you are studying for the current EA exam cycle and then something happens in the middle of the tax season. We've had to deal with that a lot the last couple of years because there have been a lot of retroactive tax law changes during the COVID pandemic. The CARES Act was retroactive and there were several others. If there is any retroactive legislation that gets passed in the middle of the year, you don't need to worry about it for the exam because they will not test you on any retroactive legislation. So this is from the official Prometric exam bulletin. And for any EA exam taken between May 1st, 2025 through February 28th, 2026, all references on the examination are to the Internal Revenue Code, forms, and publications as amended through December 31st, 2024. So through the end of 2024. And you are going to be tested on the 2024 tax year because that is the filing season that we're in, right? So we're not in the 2024 calendar year anymore. That calendar year is over, but that's the filing season that we're in. So those are the returns that we are filing now, and that is what you're going to be tested on if you take the exam between these two dates. So between May 1st and February 28th of next year, it's only going to be 2024 tax law. Okay, recent legislation. So this is legislation that affects the 2024 tax year. The Federal Tax Disaster Relief Act of 2023. This was disaster-focused legislation that did three things. It designated federally declared disasters declared from February 26, 2021. Yes, this is a retroactive bill. So it was passed in 2023, but it has provisions that are retroactive to 2021. I know that it's annoying when Congress does this, but this was actually to provide relief to taxpayers all the way back to 2021 if they were affected by a FEMA disaster. So from February 26, 2021, I don't know why it's this random date, through February 10th, 2025. Those disasters are now deemed qualified disasters for the purposes of the personal casualty loss rules, allowing taxpayers to claim larger casualty losses than allowed under existing law. And yes, what this means is if the taxpayer was affected by a disaster and it was between these two dates and they've already filed their tax return and they want to take a larger casualty loss because of this bill, then, and it was in the past, then that means that they have to amend. Okay, which I know is a hassle, but Congress does these things. So this is retroactive tax legislation, and there are provisions that will affect taxpayers going back to 2021 and through February 10th, 2025. So it's going to affect all of 2024, basically. Okay. This bill also created a new income exclusion for qualified wildfire relief payments and created a new income exclusion for the East Palestine train derailment payments. I don't think the IRS is going to ask you about these last two. These are pretty obscure, but this might actually help you if you have a client that was affected by either one of these disasters. The Secure Act 2.0 and the Secure Act 1.0, we've been talking a lot about every single year since 2019. The Secure Act 1.0 was passed in 2019, and the Secure Act 2.0 was passed in 2023. There are provisions in the Secure Act 2.0 that went into effect in 2024, and there are provisions in the Secure Act 2.0 that are going to go into effect in future years as well that have not happened yet, most of these affect retirement plans. So we're going to talk about retirement plans and the Secure Act changes when we go into that chapter for retirement plans. So I talk a lot about traditional and Roth IRAs in the webinars for part 1, and I will talk about these changes in that webinar. The Corporate Transparency Act. So we've been going through Corporate Transparency Act ping pong as accountants the last couple of years. Congress passed the Corporate Transparency Act, or the CTA, on January 1st, 2021. This was the beneficial ownership information, or the BOI reports, where you had to fill out a BOI report in order to report the details of your business to the FinCEN, which is the Financial Crimes Enforcement Network. These requirements were supposed to go into effect on January 1st, 2024, with some of the reporting requirements actually delayed until January 1st, 2025. A lot of businesses sued because they felt that this was government overreach. And there were a lot of accountants that offered BOI filings to their clients, thinking that, they were helping them. And many people did file these reports with the FinCEN. And then on Sunday, March 2nd, which 2025 was just a couple of days ago for me. I'm recording these webinars in March of 2025. On Sunday, March 2nd, the Treasury Department announced that it will not enforce the reporting rule against domestic reporting agencies and plans to issue a proposed regulation to revise it so that only foreign reporting companies must file a BOI report with the FinCEN. So that's the latest news that I have. At the time of these webinars, or at the time of the book's printing, because we're going to put this in the book too, foreign entities still have a filing requirement. So foreign entities still have to file. Domestic entities do not have to file as of right now, as I'm speaking. But who knows? It's been like back and forth for months, and this might change next week. So I'm giving you the best information that I have. That's how it is with tax law, though. You just never know what Congress is going to do. We're at their mercy. So note that the current EA exam specifications do not include these new BOI requirements. So I don't think you're going to see a question on this. You might be asked about the FinCEN, so you have to know about FBARs and the FinCEN and what that is, because the FinCEN is part of the U.S. Treasury Department, and I talk a lot more about the FinCEN in the webinars later. But you don't have to file a BOI report if you have a domestic business or a domestic LLC or a domestic corporation, which means a U.S. corporation. But foreign companies, as of right now, as I'm speaking, do still have to file a BOI report. Okay? Filing deadlines. The individual income tax return filing deadline is April 15th, 2025. The extended filing deadline is 6 months later, and it's October 15th, 2025. This is for individuals, not for businesses. Okay? We're going to talk about the income tax return filing deadlines for businesses in part 2. The FBAR due date is the same as the individual tax return due date. An automatic 6-month extension is allowed, typically until October 15th. And the FBAR extension is just automatic. You don't have to file a form in order to receive that extension. So basically, this is just a legal technicality where it's just a 6-month extension. It's automatic. You don't have to file anything for it. That's for the FBAR. But for the individual income tax return filing deadline, you do have to file an extension. If you want an extension, you have to file a form for that. And we're going to go over that in the individual webinars. Estimated tax due dates. So for individuals, the estimated tax due dates for quarterly estimated taxes are due by April 15th, June 15th, September 15th, and January 15th of the following year. Okay, this is not the same estimated tax due dates for corporations. So the months are different for corporations than for individuals, and you do need to know these for the test. So April 15th is the first estimated tax due date, June is the second one, September 15th is the third, and January 15th of the following year is the fourth estimated tax due date. Farmers and fishermen have a special estimated tax due date. They only have to make one annual payment. They don't have to pay estimated taxes during the year if they don't want to. Of course they can. They can. Farmers and fishermen can make estimated payments just like everybody else. And I want to clarify this because we get tons of questions about this. Farmers and fishermen can make estimated taxes just like everybody else, but they don't have to. If they're a farmer or a fisherman, which means at least 2/3 of their income comes from farming or fishing activities, then they can just make one estimated payment. They can either make it on January 15th if they can't file their tax return by March 1st, or if they can file their return by March 1st, not March 15th, folks. It's not March 15th, it's March 1st. If they can file and pay everything that they owe by March 1st, then that's the only payment that they need to make. So they get a choice, either January 15th if they're not filing, or March 1st if they are filing and paying on the same day. 2024 tax brackets, they're the same as last year. The individual tax rates for U.S. citizens and U.S. residents are 10%, 12%, 22%, 24%, 32, 35, and 37. Non-resident aliens filing Form 1040-NR are taxed at a flat rate of 30% on U.S. sourced income unless a tax treaty specifies a lower rate. And many times there will be a tax treaty that will specify a lower rate, especially for like allied nations that are allied with the United States, like the UK, Canada, Mexico. The US has tax treaties with all of those countries, and they're complex. Understanding foreign tax treaties is a pretty complex area of tax law. You're not going to be asked about any kind of specific treaty. You just need to know that they exist. Here are the standard deduction amounts for 2024. They are based on filing status, and there's an additional standard deduction for taxpayers who are age 65 and over and or blind. And I know that this additional standard deduction confuses a lot of newer preparers, but we're going to go over all of this in the later webinars, and I'm going to give you several examples. The 2024 retirement plan contribution limits for IRAs, for Roth and traditional IRAs, are what we're going to discuss in this webinar series. We talk about other types of retirement plans in part 2, with like 401ks, qualified plans, traditional pensions. Those are all covered primarily in part 2. In part 1, if you're going to be asked about retirement plans, most of what you're going to see on the exam is going to be about Roth IRAs and traditional IRAs. So you really need to know the rules for these. $7,000 is the traditional IRA limit for taxpayers who are under the age of 50. There's an additional catch-up contribution of $1,000 for taxpayers who are age 50 or older. 50 or older. Don't be confused by this. It's not 59 and a half. 59 and a half is the age at which you can pull money out of your retirement plan and not get hit with a penalty. But 50 is when you get a catch-up contribution, which means you get to contribute more. Okay, don't be confused by this. You need to know this for the test. Put this on a flashcard. Okay, so $7,000 is what you can contribute to either a traditional IRA or a Roth IRA if you are 49 and younger. If you are 50 or older, you can contribute an additional $1,000, which means for tax year 2024, if you're 50 and older, you can contribute $8,000. And I talk more about this in the webinars. A very common type of trick question that they will give you on the test is they will give you a married couple. They'll give you a married couple that's filing jointly, and they'll tell you that one of them is 49 and the other one is 51 or 60 or whatever. So one of them will be under the age of 50 and the other one will be 50 or older, and you have to know what they're allowed to contribute to their IRA because it's going to be different. If you're 50 or older, you can contribute $8,000 in 2024. If you are under the age of 50, then you can contribute $7,000. Okay, so got to know that for the test. 2024 FICA and SE tax. So we're talking about the Social Security and Medicare. This is the self-employment tax as well. It's all the same tax. It's all the same tax. For all my little payroll gurus out there that have been doing payroll for years, you know this, right? Self-employment tax is Social Security and Medicare. That's the same as the payroll tax that you pay on your wages, except that when you pay Social Security and Medicare tax on your wages, the employer pays half and you pay the other half. So the employer will pay half of your Social Security and half of your Medicare. But when you're self-employed, you don't have anybody else to pay the other half for you. So you got to pay both halves. When you're self-employed, you pay 15.3%. That's 12.4% for Social Security and 2.9% for Medicare. And if you're an employee working for an employer, then you pay 7.65%, which is 6.2% of Social Security and 1.45% of Medicare. So you pay half as an employee and the employer pays the other half, which is why employers a lot of times want to try to pretend that their employees are independent contractors and just send them a 1099 because they don't want to pay these taxes. They don't want to pay the half of the Social Security and the Medicare. They want you to do it. So that's why misclassification of employees happens. And we're going to talk more about that in the webinars. The additional Medicare tax is 0.9% on earned income only. Additional Medicare tax is an ACA tax. It was passed by Congress in order to fund the Affordable Care Act. And we're going to talk about the Affordable Care Act and the healthcare marketplace and the premium tax credit. The additional Medicare tax was a tax that was passed by Congress specifically to fund the Affordable Care Act. It's 0.9% on earned income, 0.9%, not 9%, folks, 0.9%, which means less than 1%, a little less than 1%. And it's only assessed on earned income, so wages, self-employment income, tips, that sort of thing. This is not assessed on any kind of investment income or capital gains or anything like that. It only affects earned income exceeding the following thresholds. So kind of on higher income earners are the ones that get hit by this. OASDI, this acronym, is the official name for Social Security in the United States. And the terms are often used interchangeably. Sometimes accountants will say OASDI or they'll say Social Security. OASDI stands for Old Age, Survivors, and Disability Insurance, because Social Security in the United States, the Social Security Office, administers all of these programs. Also, survivor benefits, like for example, I'm not 65. I'm getting closer every year. I'm not 65 yet, but I have been paying into Social Security since I was like 15 years old. That's when I got my first job. So I have more than 35 years of working. My Social Security and Medicare tax goes into my Social Security account in order to fund my retirement later. But if I do not make it to 65 because I die, then survivor benefits will get paid out to my children based on the amount that I've been paying into Social Security. Those are the survivor benefits that children can get. So it's kind of like, a safety net for people. If I don't make it to 65, then my children who are minors, one of my kids turned 18. Oh, so painful when they get older, because you remember them little. Anyway, for those of you who are parents, you know what I mean. But I still have two children who are minors, my two youngest. And if I were to pass away, then they would be eligible for survivor benefits from the Social Security office. And then disability insurance as well. So people who receive Social Security disability benefits, that's also administered by the Social Security office. And the Social Security and the Medicare that we pay on our wages and our self-employment income goes there to fund our future Social Security benefits. Now, one thing that you need to understand is that Social Security has a cap. That's when you hear OASDI, maximum wage base, they're talking about the cap on Social Security, which means if you make more than this number up here, the $168,600 in 2024, if you make more than this, then you will not pay Social Security tax on anything exceeding that amount in 2024. Now, this actually is adjusted for inflation. This cap seems to go up every single year, okay? But Medicare has no cap, which means no matter how much you make in wages, let's say you have somebody who makes $1 million in wages or $500,000 in wages, they will only pay Social Security tax up to $168,600. But they will pay Medicare tax on the whole thing because the Medicare tax does not have a cap. It used to have a cap back in the olden days because Congress used to promise people you're never going to pay Social Security on everything that you earn. It will always have a cap. But they're lying because Medicare used to have a cap. doesn't have a cap anymore. And Congress always talks about doing away with this cap as well. But as of right now, there's still a cap on Social Security, but there's no cap on Medicare tax. So no matter how much you earn, even if it's $1 million, if it's wages or some other type of earned income like self-employment income, you're going to pay Medicare tax on the whole thing. All right, 2024 kiddie tax threshold. The kiddie tax is the age limit for those under 18 and certain dependents under 24, not all dependents under 24. So the kiddie tax doesn't affect every dependent. It only affects dependents that make over $2,600 in unearned income. It only applies to unearned income, which means it doesn't apply to earned income like wages. So if you have a kid, like a minor, let's say they're 16 or 17 and they have a job and they make $14,000 or $13,000, they're not going to get hit with the kiddie tax because the kiddie tax only applies to unearned income, like investment income, like capital gains, dividends, that sort of thing. And we're going to talk more about the kiddie tax later, but I do think you need to know this threshold. The $2,600 is the kiddie tax threshold for 2024. And you also need to know the rules for the kiddie tax, which we are going to cover in a later webinar. Capital gains rates. These are the 2024 capital gains rates that apply to long-term capital gains and qualified dividends in 2024. I don't think you need to memorize any of these thresholds. I do think you need to know that there is a long-term capital gains rate as well as a rate for qualified dividends. These are beneficial tax rates that apply to this type of investment income specifically. Long-term capital gains, which is the sale of assets like stock, that's the most common type of long-term capital gain you're going to see, is when somebody sells stock that they've held for over a year. And then qualified dividends also get this beneficial tax rate, which means the maximum they're going to be taxed is 20%. So you might have somebody who's in the highest tax bracket. Let's say they make $1 million in wages. That would put them in the highest tax bracket. But if they have long-term capital gains or qualified dividends, they're not going to pay tax on those at their highest rate. They're going to pay tax at a maximum of 20%. And then the other long-term capital gains rates apply to these types of unique assets. The gain on the sale of collectibles is taxed at a maximum of 28%. Collectibles are something like artwork, antiques, gemstones, comic books, collectible stamps, coins, that sort of thing. Sometimes people will invest in these items just like a person would invest in stock. They invest in collectibles. It is a type of investing. But when you sell a collectible, it's subject to a special tax rate and it's a maximum of 28%. It's not these tax rates up here, the 0, the 15, and the 20. It's this special tax rate down here. And then unrecaptured Section 1250 gain applies to the sale of depreciable real estate property. And that's a maximum of 25%. And we're going to talk about that more in later webinars. 2024 Section 179 and bonus. This did change in 2024. Section 179 is now indexed for inflation every single year, so it goes up. And then bonus depreciation, on the flip side, is going down. The amount that you can claim ramped down to 60% in 2024. That's if Congress doesn't decide to extend it, it's going to eventually disappear. Who knows what Congress is going to do, because businesses, especially big businesses, they love bonus depreciation because it allows them to, deduct the full cost of their assets or a large percentage of their assets. But bonus depreciation is going to start ramping down and eventually disappear if Congress doesn't change this. Section 179, on the other hand, is permanent. It's a permanent provision. Congress was extending it year after year after year, and it became permanent several years ago. The Section 179 expense deduction is a maximum of $1,220,000. And there are differences between Section 179 and bonus. Of course, with Section 179, you could take 100% of Section 179 on certain assets, and bonus, you can't do 100% anymore. It's 60% starting in 2024. And like I said, eventually this is supposed to disappear. But Section 179 is never supposed to disappear. It's a permanent provision, and it's going to continue to be increased for inflation every single year. And we're going to talk more about this in later webinars. The 2024 QBI deduction is a 20% business income tax deduction, but it is taken on the individual tax return. The QBI deduction is not a deduction that's taken on the business return. It's taken on the individual tax return. I mean, of course, if you have a Schedule C taxpayer, they're just going to be taking it on their individual tax return. But the QBI deduction is a pass-through entity deduction, which means if you have a partner in a partnership or a shareholder in an S corporation or a beneficiary of an estate or a trust that has business income or business activity, then the QBI deduction is actually passed through. The information is listed on the Schedule K1, and then it is taken on the individual Form 1040. It's a deduction that's taken on the Form 1040. But the determination of whether the income actually qualifies for the QBI deduction is taken at the entity level. So we talk a lot about the QBI deduction in Part 1 as well as Part 2, because the determination is made at the entity level, but the deduction is taken on the Form 1040. And it's subject to a range that's affected by the income limit as well as the type of business activity, the SSTB activity. I'm sure you've heard that term by now if you've been doing anything in the tax law realm for any number of years. SSTB is a specified service, trade, or business. And then there's income limitations as well for the QBI deduction. And we're going to cover this a lot more in the webinars for Part 1 and Part 2. Okay, standard mileage rates. For business use of a vehicle, it's 67 cents a mile. For medical and moving, it's 21 cents a mile. The moving deduction is still available. The moving expense deduction is still available, but only for armed forces personnel, for military, basically. But it's still there. It's still there in the publications, but it's only for armed forces. Charitable is 14 cents a mile, and this one never changes, basically. This one is set by statute. These other two, business use and then medical and moving, these will vary from year to year. But the charitable has been 14 cents a mile for a really long time. The 2024 HSA limits are here. HSA means Health Savings Account. This is not the same thing as an FSA. The FSA is a flexible spending arrangement or flexible spending account. An HSA is a health savings account. These are very different. An HSA is always paired with a high deductible health insurance policy, always. So you have an HSA and a high deductible health insurance policy. They have to go together. The annual contribution limits on deductions for HSAs for individuals with self-only coverage is $4,150. This is an increase of $300 over last year. And $8,300 for family coverage. This is an increase of $550 over last year. There is an additional contribution amount of $1,000 for taxpayers who are age 55 or older. It's 55. It's not 59 and a half, and it's not 50. It's in between those two because Congress just loves to make our lives difficult, right? Congress can't decide an age at which you are old, right? So you are considered older in order to put more into your traditional or Roth IRA when you're 50. To put more into your HSA, you got to be 55 though. And I don't know why Congress decided to make all of these age limits different, but you're allowed to put in an extra $1,000 if you're 55 or older. So what this translates into basically is if you have a single person or self-only coverage, let's say it's just me and I'm not married and I don't have any kids, then I would be able to put in $4,150 into my HSA for the year. That would be the annual maximum. And if I was 55, then I would be able to put in $5,150. So $1,000 more. And then if I had a family plan, so for my husband and my kids, if I had a family plan that covered them as well, then I can put in $8,300 in 2024. That's the maximum I would be able to put in. But if I was 55, then I could put in $9,300. Got it? That's how the catch-up contribution works. Okay, FSA limits. The FSA is a flexible spending account or flexible spending arrangement. FSAs are typically offered by larger employers, like a large government employer. That's when you typically see an FSA or taxpayers who are covered by an FSA. I had an FSA when I worked for the state of California. It was like an FSA as part of my cafeteria plan. I had really good health benefits. The job was really boring. I was an accountant for the state for a few years. I was really bored when I was doing that job, but I had fabulous health insurance and I had an FSA then. The healthcare FSA maximum, that's the most that you could put into your FSA in 2024, is $3,200. And then the dependent care FSA, this is sometimes shortened to DCFSA, the maximum that you can put in, this is for daycare, is $5,000 for unmarried and couples filing jointly, and $2,500 for married couples filing separately. And this information shows up on the taxpayer's W-2 form. It's on the form W-2, but it's $3,200 for healthcare. That's the most that you could put in pre-tax. This is pre-tax. And then for dependent care, it's $5,000 for basically every filing status. That's the maximum, but it's $2,500, which is half of that if you have someone who files a separate return. The 2024 estate and trust thresholds. The estate exemption amount, this is the exemption from income tax, is $600. For a simple trust, it's $300. For a complex trust, it's $100. And for a qualified disability trust, it's $5,000. Basically, this is the amount that would be exempt from income tax. The estate and gift tax highest rate is 40%. The combined estate tax and lifetime gift generation skipping transfer tax exemption is $13,610,000 per person in 2024, or $27,220,000 per married couple. If you happen to have a married couple where both of them died in the same year, then this is the maximum amount that they would be able to pass to their heirs. So we talk a lot. I know that this is confusing for a lot of people, but we talk more about the estate and gift tax in the last webinar for individuals. The gift tax annual exclusion is $18,000. It will go up to $19,000 in 2025. And you could give as many gifts totaling $18,000 as you want. So let's say you have, 5 family members and you want to give them each a gift. You can give them each up to $18,000 in 2024. It's not taxable to them, and you do not have to file a gift tax return as long as it's $18,000 or less to any individual human person that you want to give a gift to. The annual exclusion for gifts to a non-citizen spouse is $185,000 in 2024. Gifts between spouses are generally unlimited. You could give as much to your spouse as you want. I could give my husband $1 million. He could give me back $1 million. The IRS just treats that as money going back and forth, basically in the same pocket. Gifts between spouses are generally unlimited unless your spouse happens to be a non-US citizen. And then there is a limit. And in 2024, that limit is $185,000. 2024 Earned Income Tax Credit. This is the EITC. The investment income limit for 2024 is $11,600. So if you have a person who has more than this in investment income in 2024, they cannot claim the Earned Income Tax Credit, even if they have qualifying dependents and even if their overall income is below the threshold amounts for EITC. Social Security numbers. Taxpayers with valid Social Security numbers can claim the credit, even if their children do not have Social Security numbers. Now, don't be confused by this. The law changed with this several years ago. This does not mean that if you have a dependent on the return that has an ITIN, that you can claim EITC for that dependent. That's not what it means. It means that if you have a taxpayer with a valid Social Security number, they can still claim the credit even if their children do not have SSNs, if they otherwise qualify for the childless EITC. In this instance, they would get the smaller credit available to taxpayers without qualifying children. This is called the childless EITC. In the past, these filers did not qualify for the credit at all. Okay? Don't be confused by this. I'm not saying that if the child doesn't have a Social Security number that they can claim EITC. That's not what I'm saying. I'm saying that in the past, it used to be that if you had a taxpayer that did have a Social Security number, just putting a dependent that had an ITIN on the return would make it so the taxpayer didn't qualify for EITC, even if they were below the income limits for the childless EITC, and that's not the case anymore. Congress kind of fixed that several years ago, and there's examples in the webinars, and I'm going to go over that. This is another recent change. There's a special rule for separated spouses where in some instances, in some narrow instances, taxpayers who file married filing separate can still qualify for the EITC in limited circumstances. There's a little checkbox at the top of the Schedule EIC that allows you to check the box if the taxpayer is filing married filing separate and still qualifies for the credit. It's very limited circumstances where you would see that, but it is there. It's on the schedule. 2024 earned income tax credit limits. I don't think you need to memorize these thresholds for the exam, but you do need to know that you can qualify for EITC even if you don't have a child. This is called the childless EITC. Your AGI has to be pretty low in order to qualify. If you don't have any children, the AGI thresholds are much higher for taxpayers that do have kids. And then I also think you need to know that if you have more than 3 children, that you're not going to get more EITC with more kids. 3 or more, that's the maximum. There's a limit to the amount of EITC that you can get with children, and it increases the more children you have, but 3 would be the maximum. You're not going to get more EITC if you have 4 kids, 5 kids, 6 kids, and so on. But you can get EITC even if you don't have a child, if the taxpayer's AGI is below these thresholds here at the top. Child and Dependent Care Credit, this is the CDCTC. I know the IRS loves acronyms, but they started using this one a couple of years back. This is the Child and Dependent Care Credit, very commonly called the Daycare Credit. The Child and Dependent Care Credit daycare expense limitation is $3,000 for 1 child and $6,000 for 2 or more children. This is the most that you can use as qualifying expenses, and then the credit itself is going to be a percentage of this, like it's 20% or 30% or whatever, based on your AGI. But these limits to the qualifying expenses you need to know for the test. It's $3,000, that's the maximum for 1 child, and $6,000 for 2 or more children. And then the taxpayer actually gets a percentage of this based on a sliding scale. The 2024 child tax credit is $2,000 per qualifying child. This is the non-refundable child tax credit. Listen to what I'm saying. $2,000 is the maximum non-refundable child tax credit, which means this will reduce your tax, but it will not create a refund. The additional child tax credit is the refundable component of the child tax credit. So there's a CTC, which is the child tax credit, and there's an ACTC, which is the additional child tax credit. This is the refundable component, which is a maximum $1,700 in 2024. And I know that this might be a little bit confusing, but I'm going to explain the nuances here between the child tax credit and the additional child tax credit. So $2,000 for the CTC and $1,700 for the ACTC, which is the refundable component. The CTC phase out begins at $400,000 for married filing joint and $200,000 for all other filing statuses. The ODC and the adoption credit. So the ODC is the other dependent credit or the credit for other dependents, and then the adoption credit. The adoption credit is $16,810. That's the maximum per child in 2024. The AGI phase out range is $252,150 through $292,150. This is the range for all filing statuses, which is unusual. So the adoption credit is unusual. It has a lot of unusual features. One of the unusual features is that the phase out range is the same for all filing statuses. Like if you're single and you're adopting a child, or if it's a married couple and they're adopting a child, this is the phase out for all filing statuses, which is unusual. Most of the time you have a different phase out range for a married couple and for unmarried filers. Like the slide we just discussed, there's a different phase out range for the child tax credit if you're married, filing joint, versus unmarried filers, which is, $400,000 and $200,000. That makes sense. But with the adoption credit, it's the same phase out for all filing statuses. And I always like to make a point of that because students will ask me this, usually at least 1 or 2 every single year. What's the phase out range for married filing joint and for single? It's the same. For the adoption credit, it's the same for all filing statuses. And this is the maximum per child. So if you actually adopt more than 1 child, You could take this amount of credit per child. The 16,810 is the maximum. The adoption credit is not allowable if the taxpayer's income exceeds 292,150. So this would be the phase out maximum. The adoption credit is non-refundable, but there's a carryover, which is also strange. You are allowed to carry over any unused adoption credit forward for 5 years. So in that regard, it's a little bit close to the charitable gifts. Like with charitable gifts, it's the same. If you can't deduct all of your charitable gifts because you've donated more than the AGI limit in the current year, you're allowed to carry it forward 5 years. The adoption credit is the same way. If you can't use it all up, it's a non-refundable credit. If you can't use it all up in the current year, you are allowed to carry forward any unused credit up to 5 years. And then after 5 years, if you haven't used all of the adoption credit carry forward, then you lose any remaining. The credit for other dependents or other dependent credit, this is also a non-refundable credit. The maximum credit amount is $500 for each dependent, and there's no refundable portion. This is a non-refundable credit. So if you happen to have a taxpayer who doesn't have a tax liability, then they don't get to carry this forward to any future year. If you can't use it, you lose it. The 2024 APTC and PTC, this is the premium tax credit. This is the credit that taxpayers can get when they purchase their health insurance through the healthcare marketplace or healthcare.gov. The American Rescue Plan Act temporarily removed the 400% FPL ceiling. This is the federal poverty line ceiling. And I'm going to talk more about this in the later webinars. If you have no idea what I'm talking about, just listen to me. This is the federal poverty line ceiling. This is commonly called the subsidy cliff, where if you made too much money and you got your insurance through the healthcare marketplace and you got a subsidy, if you made too much money, then you had to pay back your premium, right? I know if you've been in this business a while, you've seen at least one or two of these where the taxpayers got health insurance through the marketplace and they underestimated the amount of money that they were going to make, and then they had to pay back their premium tax credit. They had to pay back their subsidy. For 2024, the repayment caps range from $375 to $3,150. I don't think you need to memorize that for the test, but I think you do need to understand how this all works, the premium tax credit. And it depends on the taxpayer's income and their filing status. The ACA subsidy cliff is scheduled to come back in 2026. 2024 education-related credits and deductions. The American Opportunity Tax Credit is $2,500 per student for the first 4 years of higher education expenses paid. The Lifetime Learning Credit, another education credit, is 20% of tuition paid up to a credit of $2,000 per tax return. And these are different in that regard. So it's $2,000 per tax return for the Lifetime Learning Credit. With the American Opportunity Credit, it's $2,500 per student. So if you have like 5 students, like 5 college students, then you could potentially take $2,500 per student if you had multiple students in college in the same year. But the Lifetime Learning Credit is a maximum of $2,000 per tax return. The Coverdell Education Savings Account, also called an Education IRA, the maximum contribution limit is $2,000 per beneficiary in 2024. Section 529 plans, these are also commonly called Qualified Tuition Programs or QTPs. 529 plans now allow distributions of up to $10,000 for educational expenses in connection with the enrollment at a public, private, or religious elementary or secondary school. Contributions are considered gifts for tax purposes, subject to the gift tax limits. In 2024, up to $18,000 per beneficiary. This is the gift tax limit. So what this means is that you can put up to $18,000 per beneficiary, up to the gift tax limit, into a Section 529 plan, and you don't have to file a gift tax return. So that's what it's tied to. Student loan interest deduction. Student loan interest includes both required and voluntary interest payments. The maximum deduction per return is $2,500 regardless of filing status, although married filing separate filers cannot take the deduction. So if you're filing MFS, you cannot take the student loan interest deduction, and it's $2,500 is the maximum, even if you have, a married couple and both of them are paying on their student loans. So this limit is per tax return. The educator expense deduction, this is also commonly called the teacher credit. This deduction is a maximum of $300 in 2024. 2024 personal and dependency exemptions. It used to be, before the Tax Cuts and Jobs Act was implemented, that everyone listed on the tax return would get a personal or dependency exemption. It was like a dollar amount that you were able to basically deduct from your income. I now have to explain this because, you know, there are people who are now in this business that weren't in this business when personal and dependency exemptions existed. It doesn't seem like that long ago for me, but the Tax Cuts and Jobs Act was basically implemented in 2018. And that seems like 5 minutes ago for me, but I realize it's been several years since this change was made. This was a temporary change. So personal and dependency exemptions were only eliminated through the 2025 tax year by the Tax Cuts and Jobs Act. Although the current exemption amount is zero. So legally, I guess you could say they still exist. The amount is zero. So that's what it says in the law. The exemption amount is zero. The ability to claim an exemption may make a taxpayer eligible for other tax benefits. So for example, we still say that you are claiming a child's dependency exemption, even though the exemption amount is zero. That's just how it is. And this is a temporary change. So personal and dependency exemptions are supposed to come back. Although for 2024, there are still no personal and dependency exemptions. However, after this big long explanation, the reason why I do explain this is because the dollar amount of the personal and dependency exemptions is still important, because for 2024 tax year filings, the gross income limitation for a qualifying relative is $5,050. This dollar amount right here in red that you can see is what the personal and dependency exemption would have been in 2024 if the Tax Cuts and Jobs Act hadn't done away with personal and dependency exemptions temporarily. Once again, this is temporary change. So the gross income limitation for a qualifying relative is basically the personal and dependency exemption amount. It's $5,050. And this is also the exemption that qualified disability trusts get. The Tax Cuts and Jobs Act did away with exemptions for individuals, but did not do away with exemptions for trusts and estates. I don't know if Congress forgot about it or if that was always the plan, to just not touch the exemptions for estates and trusts. But for individuals, the personal and dependency exemption was reduced to zero, but that dollar amount would have been $5,050 in 2024 if they were still around, if they hadn't been reduced to zero by the Tax Cuts and Jobs Act. But this dollar amount is still important, because if you have a qualifying relative that makes more than this, they generally cannot be claimed as a dependent. Okay. After that big long explanation, right? Okay. 2024 nanny tax on household employees. The nanny tax threshold is $2,700 in 2024. Don't be confused by this, because this is really close to the kiddie tax threshold. It's not the same thing. They're not even related. The nanny tax and the kiddie tax are not even related. Kiddie tax is a tax that applies to the unearned income of a child. The nanny tax is the threshold at which you are obligated to withhold and pay federal FICA, which is Social Security and Medicare taxes, on any household employee. So if you hire a nanny or a chauffeur or some other type of household employee to work for you in your house, then that is the limit, the dollar limit, $2,700, where you have to start withholding Social Security and Medicare from their wages. A household employer is also required to pay FUTA taxes if they paid a household employee $1,000 or more in a calendar quarter in the current year or prior year. These thresholds are on a per employee basis. So what this means is that if you hire a nanny and you hire a chauffeur and you hire like a private gardener to work in your house, this would obviously be like some wealthy person, right? Many times wealthy people will have household employees that just work for them. This is not a business, which is why we're talking about it here. If you're a household employer, that's not a business. you're hiring people to work for you personally in your house, then this is the limit where you have to start withholding and paying Social Security and Medicare. And household employers report this activity on Schedule H, not Schedule C, not Schedule F, Schedule H. If you hire a household employee, it's not a business. But if you are a household employer and you hire a nanny, for example, then you have to report that on Schedule H. It's a special schedule, and this is the threshold, per employee threshold, where you have to start withholding and paying Social Security and Medicare on their wages. Form 1099-K. There are new rules for the Form 1099-K. The 2024 requirement for Form 1099-K reporting to the IRS is $5,000. That means if you have a third-party payment processor like PayPal or Stripe, then they are going to issue a 1099-K once the threshold reaches $5,000. Like, for example, if you sell $5,000 worth of items on eBay and you get payments through PayPal, then PayPal is going to send you a 1099-K once you have $5,000 or more in payments. Of course, you're going to have to report this on the tax return unless you want to receive a notice and deal with that later. But these reporting requirements are not going to apply to personal transactions such as birthday or holiday gifts, sharing the cost of a ride or a meal, or paying a family member or another household bill. Although sometimes you'll have taxpayers that will still receive a 1099-K for this type of activity when it shouldn't have to be reported. The IRS has addressed this problem somewhat by adding additional lines to the Form 1040 that will allow you to report a non-business activity that was reported to you on the Form 1099-K. So if it's something where it shouldn't be taxable and it shouldn't have been reported on the Form 1099-K, for example, a personal type payment, then there is a place now on the Form 1040 where you can report this. Like an example of this would be, let's say I have a ring, like a diamond ring that I have, that maybe I bought it for $10,000 and now I want to get rid of it. And, maybe it was something that an ex gave me or something that I bought myself that I don't like anymore. That's a personal item. I'm not in the business of selling jewelry. I don't sell rings. I don't have a ring store or anything like that. And let's say I bought it for $10,000 and then I put it on eBay and I sell it for $5,000, right? I have a personal loss. That's not a deductible loss. I can't deduct that loss because that was just a personal diamond ring. It wasn't an investment or anything like that. This is like used jewelry that I'm selling. I sell it on eBay. I get $5,000. I have a loss on the sale of the ring. And then PayPal or eBay sends me a 1099-K for $5,000. The IRS is going to think that's a business activity unless I tell them that it wasn't. So I would have to report that sale, and I would have to report it as a non-deductible loss. I would have to report that sale, that $5,000 that I received. Otherwise, I'm going to get a notice later. And I would have a loss on that ring, but it's the sale of a personal item. So the loss is not deductible. And I would have to put it on the tax return if I received a 1099-K. Otherwise, I'm going to get a notice later. But the 1099-K is only supposed to be issued for business activities. The reporting requirements do not apply to personal transactions, and they're not supposed to. But of course, eBay has no way of knowing if you're in the business of selling jewelry or whatever. So they're going to send a 1099-K if you exceed this $5,000 threshold, and you're going to have to put it on the tax return unless you want to deal with a notice later. And then, of course, if the person is in the business of selling items online, then that activity would go on the Schedule C. 2024 tax form changes. So these are new changes to the tax forms in 2024. The Form 1040 now includes a checkbox and an entry field in the filing status section that allows taxpayers to elect to treat a non-resident alien spouse or dual status alien spouse as a resident. This is a new change. This election has always been available, but this is a brand new checkbox where you can make this election. So the checkbox on the Form 1040. This election always happens on the Form 1040, never on the Form 1040 NR, okay? Schedule 1 now includes an entry field for taxpayers who had amounts reported on a Form 1099-K in error or for items sold at a loss, as well as a new line for reporting cryptocurrency staking rewards. So this is what I was talking about in the last slide. So now there's an entry field in order to report items that were sold at a loss where there were personal items, and the amounts were reported on the Form 1099-K in error. The Form W-2 wage and tax statement now includes a new Box 12 code for Medicaid waiver payments excluded from income under IRS Notice 2014-7. We talk a lot more about this later. New Form 1099-DA, digital asset proceeds from broker transactions. This is a brand new form. The broker is not required to file a Form 1099-DA prior to 2025, although you might see one. The broker may, however, voluntarily file a Form 1099-DA or a Form 1099-B, proceeds from broker and barter exchange transactions for each customer for whom the broker has effected a sale of digital assets. So this would be like cryptocurrency, NFTs, that sort of thing. It's going to become mandatory in 2025, but it's not mandatory for 2024. Publication 1244, Employees' Daily Record of Tips and Report of Tips to Employer, is obsolete. Publication 531, Reporting Tip Income, will no longer be updated annually. It is changed to continuous use. Form 5329, Additional Taxes on Qualified Plans, including IRAs, adds 2 new codes for the exceptions to the additional tax on early distributions on eligible distributions to a domestic abuse victim and emergency personal expense distributions effective for distributions made in 2024. And I'm going to explain this later when we go into the webinars for retirement plans. In 2024, if you have a person that withdraws money from a qualifying retirement account, like an IRA, like I withdraw money from my traditional IRA because I need the money because I'm a domestic abuse victim or for an emergency personal expense, then I am allowed to avoid the 10% penalty if I pull the money out before I turn 59 and a half. Because if you pull, you should know this, if you pull money out of a retirement plan early and you're not at least 59 and a half, many times you will pay a 10% early withdrawal penalty. But you can avoid that penalty if you qualify for an exception. You can avoid that 10% penalty. So this would be effective for distributions made in 2024. And these 2 new codes are on Form 5329. And I'm going to show that to you when we go into the retirement plan webinar. Form 8888, Allocation of Refund. This is the form that you use to split your refund. And I talk more about this form in part 3 because it's part of the filing process, right? When you have a taxpayer that wants to split their refund into multiple accounts. It's now only used to split a direct deposit refund between 2 or more accounts, or to split a refund between a direct deposit and a paper check. You can technically split a refund between a direct deposit and a paper check. I've never had anybody do that, but I mean, you can if you want to get part of it as a direct deposit and part of it as a paper check, or you could choose 3 separate bank accounts to deposit in, but 3 is the maximum. The program allowing for depositing refunds into a Treasury direct account or to buy savings bonds, as well as the ability to buy paper bonds with refunds, has been discontinued. That's it. That's the end. The next unit is Unit 1, which covers preliminary work with taxpayer data.